okay, well, I've got that plan, but I don't have enough dollars to put into it. And they don't take advantage of putting those dollars away for their, for themselves, for their key employees, for the family members, and tax deducting that, and ultimately lowering their taxable income. And there's a whole other slew of good, tax planning ideas that we could go down a rabbit hole, and discuss that people don't take advantage of. But that's kind of what I mean. I see that so often where either they're not paying themselves or not paying themselves what they should be paying themselves.
Welcome to the Business Ownership Podcast, brought to you by Awareness Strategies, helping you navigate the waters between entrepreneurship and ownership. Hey there, peeps. This is Michelle Nedelec, and I'm super glad that you're here today because I'm here with my most amazing guest, Frank. Frank, thank you so much for being here with us today.
Thanks for having me. Excited to be here.
Awesome. So give everybody the highlight of who you are and what you do for business.
So I am currently a financial advisor by trade, but I also have a kind of hybrid institutional real estate arm. So, probably about 15 years ago, I got out of the restaurant hospitality business and kind of went all in on this, after kind of identifying a gap in the industry where I felt like there was a lack of proactive, independent, objective advice for the fast moving entrepreneur. And I could kind of relate to, running our restaurants and how busy we were. And unless somebody was putting me in a metaphorical headlock to show us proactive planning ideas, we were missing a lot of opportunities. So I said, hey, I think I can kind of package this and focus on a certain type of entrepreneur, where again, I'd say we focus on more quality than quantity. So we have a lot of clients that are in the growth phase of their business where they're kind of starting out, and then all the way up to the ultra affluent entrepreneur that's accumulated a large degree of wealth. And what ideas can we introduce to that individual to put a moat or two around the fortress and make sure that whatever their goals are and whatever they want to leave to their heirs or people they care about, they do, and don't give too much to the federal and state governments.
Thanks. Love that. So when it comes to kind of estate planning and things, and you're looking at the businesses, what are you seeing as the biggest problem that most small businesses have, or restaurants specifically?
So I would say that, for a small business that's starting out, estate planning is low on the list of like planning ideas. They're more in, hey, how do we make money? How are we sustainable? How do we save money in income taxes? That type of thing. But for the right type of business that has that potential to be, a large asset down the road, they could or should be looking at ideas where, they can recapitalize a business potentially and, do things to not affect the day-to-day operations. But if that business that's worth 1 million or 5 million today is going to be worth 50 down the road, I know that's hard to project, but how do we kind of, take some of that value off of the balance sheet, so to speak, and park that into a, trust or a limited partnership or something where if that business grows to a substantial value down the road, that piece that we, removed from a taxable estate is now, excluded from, potential estate tax exposure.
Nice. So I think we'll get into the kind of, once you have capital and you've built it, what do you do with it? How do you keep it away from the feds as much as possible? Because obviously money in your hands is going to be more useful to being able to pay them more money later down the road than it is if it's in their hands first off. But let's talk about kind of the smaller guys, the guys that are hustling, grinding, and they're pinching pennies to save a dollar because, when you're starting a business, it is rough, especially the restaurant business where your margins are so low. And then you got staff that's stealing money from you, and you got guests that are complaining about stuff that they shouldn't be complaining about. Like, I totally get the restaurant business to say to somebody, hey, you got to set aside a couple of $100 a month for this. They're going, are you kidding me? Like, how am I going to do that? How do you answer that? And kind of, how do you work with that crazed mindset that I know is there of, yeah, I'll do it when I have the money.
Yeah, I think that's easy to say, and it's an easy default for a young business owner that's saying, "Hey, I just can't do it." And oftentimes I ask that question, are you sure you can't do it? Do you really understand like what your budget is? Not all, not all within the business, but outside of the business. Like, have you really truly done a self-assessment of where all your dollars are going, either within the business or outside the business? And if you can honestly say, hey, there's absolutely no way that I can set aside $100 or $200 a month, then, we may have bigger problems. But
Exactly.
oftentimes when I push back on that, they come back and say, okay, well, yeah, I think I could cut here or cut there. And then, you got to start saving, like start small. If it's not $100, start with 50, do an auto withdrawal from your account. So they're not high profile dollars that you're seeing that you want to spend, that you want to do stuff with, and it's just gone. And then when you realize you can survive that, go to 100, then go to 200, then go to 500, 1,000. I did that honestly when I left the restaurant business. I kind of had a falling out with my family and partners, and I left with very little. So I was preaching this to my clients as a financial advisor, and I wasn't doing it myself at first. And I had to kind of go through that, and did that, and realized I was, spending money on trivial stuff. And ultimately, when I was doing that savings, you're going to run into a rainy day sometime. And I was shocked at how much money I was accumulating in that account, which really did help me with some unforeseen costs, things along there. But once you do that budget or self-assessment, and you can kind of see, hey, here's where these dollars should go. Here's what I can really save in my personal life, my business life. Then it's, what am I doing for my business? Where are my dollars going? And a lot of times I see people, that are looking to, grow the business, but they're not paying themselves. So I'm a big advocate of paying yourself first, right? You gotta take care of yourself. And, I see people that aren't taking a salary, but they're still paying, a substantial amount of income taxes. And I say, hey, listen, redirect those dollars to pay for yourself. They just can't
Okay,
connect the
dude,
dots
let's
there.
stop the bus right there. If you can't afford to pay yourself, you're doing something radically wrong with your taxes if you're
Yeah.
paying high taxes. I
Yeah.
totally get if you're not paying any taxes and you're not paying yourself
Yeah.
and you're going, how am I going to pay my staff?
Yeah.
And
Yeah.
going, you're kidding me. I can't put this away. Like, to me, that is when I guess I was 23 when I started my first 3 businesses,
Hmm.
3, and my spouse was running a restaurant. So to me, I get that whole mayhem, and I get when you don't know what you don't know. And
Yeah.
here's my, if I could if I could tell my younger self anything, what I've learned is that well, I'll give you an example. In that kind of timeline phase, I needed a car. Like, I needed a car to be able to get around in the city that I was in. And single mom,
Yeah.
had a child under 3, and went, I just need a car. So I, instead of opting to buy a used car that was going to quote unquote save me money, I figured I'd buy a new car so that I didn't have any payments. I knew it was going to break down. If it did break down, I'd do it. But I got the cheapest car I could possibly
Yeah.
find on the lot. And I devoted to making those payments, even though at the time I think it was $200 a month, but that was an insane amount for me. $200 was
Hmm.
an insane amount, but I went like, I have to do this in order to be able to get through the day. And somehow, some way, that money always came, and it was never an issue to make
Yeah.
that payment. It was always still
Yeah.
the issue to pay
Yeah.
all the other things that were going on. And kind of, if I knew then what I know now, it's to have all of those payments set up, to have the essentials taken care of, because they do take care of themselves in a weird sort of way.
Yeah.
And it becomes more of a mindset of kind of, okay, that's done, that's compartmentalized, and now I have to take care of this. And then that's where the focus goes, is to creating more.
Yeah.
It's a really cool thing that happens with the brain that most of us just simply don't understand, that
Yeah,
that's what's
I
going
think
on.
that's spot on. I think you have to know your numbers, like through your business, right? There's so many people that are operating that come to us for consulting, and we ask basic question about operating costs, labor costs, food costs, whatever the industry is, and they stumble and they can't answer that. And then I go, well, you can't make a educated decision as to how you should save or how you should make some of these other decisions when you have no idea where some of these dollars are going. So, sometimes that's well received. Sometimes it's people get defensive, but like, you need to know your numbers. And then the other thing I would say is the biggest risk any of us can take as business owners is being a business owner, right? Like, you're taking that leap to invest in yourself and your family, your employees, people you care about. And I see people that do that, but again, don't pay themselves or don't pay themselves what they should pay themselves. And they don't, take advantage of the benefits of owning that business for, tax deductibility of certain things, certain living expenses. A lot of people say, well, I travel here or there for business, and I'm scared to expense it, or I don't write off my phone bill or my gas, or there's just little things that people do. And I always go, hey, listen, ultimately you want to check with your tax counsel, but I like to walk up to the line and stand right there. You don't want to step over the line, but I see so many people that.
But there is no line in taxes. People think there's a line.
Yeah.
Well, and then technically there's two lines. So there's
Yeah.
the black. This is black. You cannot do this. And this is white. You can absolutely do this.
Yeah.
And everything in the middle is very gray.
Yeah.
And you have to understand that everything in the middle, it just needs to be justified. Is it really going towards your business? If it really is going to your business, then absolutely write those things off. That's the whole point of those laws.
Yeah. I agree. Like, there's so many people that are petrified of, going anywhere into that gray area. And I just, I sit there and I can say, hey, do you do X, Y, and Z? Like, do you, when you go here or there, like, do you discuss business? Your husband and wife, you're both running the business. Like, you got to be able to write off some of the stuff that you're doing, and it's justifiable.
Well, and let me explain why there's a gray zone in the tax thing in a way that I think people can understand. So if I owned a dog, all right, let's say cat sanctuary, right? Where people bring in their cats and I have strays all over the place. That is my job, is to take care of strays and to find them a good home. Everything I do for those cats is write off. The food is write off. The cage is write off. That everything is write off for those cats.
Yeah.
If I, as a business coach, have a cat, it's a lovely cat and it's a wonderful cat and it's my cat. I can't write off its medications, its bedding, it's everything. That's why there's a gray area, because they don't know what your business is, and you have to define to them what your business is. And if it helps you to build your business and grow your business, it is write off. Period. End of story. And talk to your tax accountants, because those rules may change in the future. God knows. With what's going on right now, a lot of those rules may change. But as of the time of this recording, they are write-offs.
Yeah, you've got to swing the bat, so to speak. And again, you're taking on a ton of risk by being a business owner. And if you're not taking advantage of some of those things, you're losing. You're losing big time. And again, most people, I say, look, I know there's, IRS agents, and they keep pumping up all these, they're coming for us all. But, in all reality,
they're not nearly
the
as scary as they sound.
Yeah, the likelihood that a small business owner is going to get audited and locked up because they bought the cat bed and the medication is slim and none.
And understand too that being audited isn't the end of the world. In fact, I thought it was fantastic when, ours was, granted, it's Canada and it's only the GST police, but it was great because all I did is ask them 100 questions. I was like, oh, and how does this work? And how does that work? And how does this work? And it was the best education I had on the taxes when they were there, because they were there and I could ask them whatever I wanted to. So that was fantastic. But I want to go back to your point on paying yourself first. So I have heard that since I was about 17. And I have, in the last 30 or so years, come to the realization that people mean different things by that. So when you say that, what do you mean by it?
I mean that, again, if you're working in a business, you should be taking a salary. A lot of people don't do that. They're scared. They say, hey, you know what? I've got to get the get the business, supremely profitable before I do that. My wife helps. I see that all the time. My wife or my husband helps in the business and basically works here semi full time, but we don't pay them. They work for free. And again, then I look at the bottom line when we get down to the tax return, and they're paying taxes. So I say, hey, look, you've got your spouse in the business that's helping you, but you're not paying them. Sometimes they have their kids, key employees, other family members in the business, and they're not paying them. And ultimately they're paying, the IRS. I said, take care of your key people and your family members, pay them, and deduct that from your, gross adjusted income. And, that's more money in your pocket for today. Social Security credits. If you've got a business and you've got like a qualified plan, people don't understand, well, okay, well, I've got that plan, but I don't have enough dollars to put into it. And they don't take advantage of putting those dollars away for their, for themselves, for their key employees, for the family members, and tax deducting that, and ultimately lowering their taxable income. And there's a whole other slew of good, tax planning ideas that we could go down a rabbit hole and discuss that people don't take advantage of. But that's kind of what I mean. I see that so often where either they're not paying themselves or not paying themselves what they should be paying themselves.
Right. Well, and I also, and again, at the time of this recording, so go and check with your tax accountants. But if you are working for your company and you're not paying yourself out, you should still be invoicing the company, because that then becomes an account payable to the company that still comes off of the records. And instead of going into taxes first, it goes into your accounts receivable first, and then therefore it becomes write-off. Now, of course, I totally get you gotta balance everything with the T's and all that kind of fun jazz, make sure that you still got cash flow. But look into that, because it is really silly to not put that in as an invoice. There's only what I can think of two extreme circumstances where you would not want to have those invoices laid out for your company, but most companies aren't going through that. So
but a ton of times you see people that are spending their own personal time and money doing stuff related to the business, and they don't take the time to invoice the business, and they're losing.
Exactly. Like, why wouldn't you? That's the whole point, is when the money comes, then you pay it off, but you need that paper trail.
Live through your business. People don't understand. Live through your business. Like, you're taking on a ton of risk. You should be living through your business. And there's a lot of good things. We'll off camera after this recording, we'll get into some real specific stuff. I don't know if we should put on tape, but
we'll get the ins and outs. So talk to me about right now about the idea of, well, one, life insurance outside of a business and life insurance inside the business. So if somebody is married, let's say hypothetically, just because it's 90% of the situations, husband's going out running the business and the family is dependent on that income. Do they pay for the insurance outside with post salary dollars, or do they pay for it inside the company with revenue dollars?
So that's a good question. And this is another like little bit of a gray area question, and it depends on like the circumstances. So when you pay for life insurance, technically you pay with after-tax dollars, and your death benefit is completely tax-free, right? So it's simple. If you've got, the prime income earner, or both you guys are, or valuable to the family, and if your income stream is cut off by the unforeseen and you pass away, those tax-free dollars come in, and then the spouse puts them in their checking account. So we always have that conversation. I'll kind of start there first before I go down the business road. But a lot of people don't understand, hey, I've got, what's my true need for death benefit? A lot of people say, well, I make 200, 300, 400 a year. I'll buy I'll do $1 million policy for my spouse and she'll be fine. It's $1 million. And they don't realize that when you factor in mortgage, kids' expenses, other liabilities, and leftover, that's not going to get your spouse very far. Also, if that tax-free death benefit comes in, your spouse is now subject to predators, creditors, divorce, she or he could go remarry, 2 days later, and now that $1 million is subject to divorce, and you can kind of disinherit your kids when you thought that was a good idea. So sometimes, depending on the situation, we'll talk about like a irrevocable life insurance trust, where those dollars would come in and your spouse would have access to them, but they're not sitting in their checking account, where now they're subject to all those other risks there, and you can appoint a trustee that you care about. Now, if you get into the business side of things, sometimes we see where you might treat the business owner as like a key employee, right? So you could say, hey, it's a legitimate expense. They're a key employee. I'm going to pay with it through taxable dollar, or through after tax dollars within the business, and then try to write that off. So if it's a term policy, it's not a big deal. But if somebody's really trying to use that as a legitimate write-off expense, and it's some type of like permanent or cash value type policy, it kind of defeats the purpose, because you go and take the write-off, but the cash or dollars that you're now accumulating in this life insurance investment account that's on the balance sheet of the company, you don't really get those dollars, the benefit of that. So sometimes we'll see people that, the owner of the policy might be the business, but the beneficiary would be outside the company. Another thing that kind of comes up a lot is like buy-sell agreements. If you've got a partner in a business, right? So there's kind of two ways to skin the cat there. Oftentimes there's like a cross-sell buy-sell agreement, where you've got two partners, and let's just say they're 50-50 partners, and they have an equal amount of death benefit on each other, and they'll just have the business own the life insurance there. If one of them should die, and those death benefit dollars come in within the business, they can truly buy out the partner, but they don't receive a step up in basis on those dollars coming in. And if they go to sell the company, they're ultimately going to pay on that gain there. So we typically encourage a cross-sell arrangement where the business partners own the policy on each other, and the benefit would go directly out to the spouse versus the dollars coming into the company.
Hey, for those who don't know, what's a step up in basis?
So a step up in basis is the basis in your company or asset, anything you own, house, business, anything. You've got, essentially the money that you started the business with, right? So you could say, hey, here's the cost. We bought this property. Here's the business. And ultimately, when you pass away with that particular asset, there's typically a date of death assessment on what that value is. And when and if you go to sell that asset, you want that basis to be as high as possible, so your taxable gain is as minimal as possible. So what we see in that regard with that life insurance is, if they don't get that step up in basis on that insurance value, they kind of lose in that scenario. So the step up in basis is, again, if you have that business over time and you're doing things effectively, like we talked about a few minutes ago, you're depreciating the value of the business. So your taxable basis may be X, but we're taking deductions to save money and income taxes along the way. So it's lowering your basis in that asset. So it's really important to understand that basis figure when you go to sell that asset.
So let's use super hyper simplistic numbers. Say you went into your business is worth $1 a share each. You get to the point where you build it up and it's now worth $100 each. Yeah. Then which one is your basis point? What are you taking up and down? Just use that as an example.
Yeah. So in super vanilla terms, your original basis is what you put into that, right? So depending on your tax bracket, let's just say roughly, 20%, you're going to get taxed 20% on your original basis based on that share price. So I think you said what, $1 to $100.
Let's just go super simple math.
Yeah. So you're going to pay, at least at least 20%, 20 to 30% in taxes on that dollar amount, that new $100 amount. And oftentimes, people don't really understand that. It's kind of a double-edged sword. You own the business, you want to depreciate everything you're doing along the way to shelter income taxes, but then when you go to sell the business, you got to understand what
Gotta
the
inflate
reason why
everything.
you did all that stuff, because then you can get dinged on the back end. So there's some good advanced planning strategies, but there's it's, you want to be well, it needs to be well thought out. You need to have advisors that are going to consult with you and give you the ramifications of all those decisions. And it's fantastic if you grow a business to that to that point in time, but you really want to understand what the tax impact is going to be.
And I think the moral of this story is, regardless of whether or not you have a partner and you have a very savvy business, or you have a family run business and you're just there to make some money, you still need to understand all of these things, because the tax department understands all of these things.
Yeah, on that, and just again, I know we're talking businesses, but like if you've got stock accounts with a low basis, you got family members that bought Apple stock decades ago, and they gift you the stock. It's great. Same thing with real estate. A lot of people inherit real estate or gifted real estate for a discounted cost over a parent's lifetime, and they don't understand that, hey, we might go and sell it, but you inherit your original parents' basis years ago. So the way the tax law is written right now is, upon death, if your parents still own that asset and then you inherit it, you get that date of death or up to date basis. So if you had $1 million piece of property and your parents bought it for $1 million and they gift it to you for peanuts or $100,000, and then your parents pass away, you still have that $100,000 basis. And if you go sell that for $1 million, you're going to pay an arm and a leg in taxes. Where alternatively, if the parents died with the asset that they paid $100,000 for, and now it's worth $1 million, your basis is now $1 million date of death when the parents die. So you could sell that property and pay next to nothing in income taxes. Same thing with stock, same thing with jewelry, artwork, anything that's out there.
And of course, again, consult with your tax department, because of course in Canada that is different if it's farmland, if it's property
I
land,
forgot. I'm
if
talking
it's business
US
land.
terms.
Exactly. And we could get into so much stuff with this, but I love talking about this. But give us an example of a Cinderella story of one of your clients.
It's good. Let's see.
And of course, in this whole realm of things, so the Cinderella story, keep in mind, people, as he's thinking about an example, usually Cinderella ends up in the castle. Of course, when it comes to financial services, Cinderella is probably not around anymore.
there's a lot of good stories. It's hard for me to pick just one, but I've got a client that is in the elevator business, and we've been working with him for probably 25 years. So this actually happened a little bit before we got involved, but he was, I think, 18 years old, and his father died in a elevator accident. And he was in high school. He dropped that. Well, I think he graduated high school, didn't go to college, came into this business that was successful, but not ultra successful. And he just worked his tail off to kind of grow this business. We do a lot of stuff for him in terms of estate planning, life insurance planning, money management, buy-sell agreement. He's got a few minor partners now, but he ultimately took a business that was probably worth, $5 million on a good day. And he got an offer last year for about 120 million on that business. And he works like a dog. I'm lucky if I can get him on the phone. I said, we need to meet, and he's never, ever available because he's chasing it so hard. But that's a story I think about, where he probably had everything stacked against him, and he really took a business that was, successful, but could have folded easily at that point in time, and took it to another level. But there's definitely a a number of situations like that I can kind of discuss or talk about. A lot of great clients, a lot of great industries.
Hey, so what are some of the stumbling blocks that somebody might be having right now in their life or their business, thinking, "Oh my God, Frank, I need you so badly"?
Um, I would just say perseverance. Like, just don't give up. Like, you're gonna have a lot more hurdles and issues than victories, especially early on. And one of the things, like, several of my mentors told me early on, is like, until they, you know, lock the doors on you and you're down to your last dollar where you can no longer go on, like, don't give up. Like, it's the easiest thing to say, you know what, I'm just going to give up. I'm going to fold it up. But nobody got successful, not working for it. And it's easiest thing is to look at our, trials and tribulations and just say, hey, you know what, I'm out of it. I'm out of energy. I just want to give up and fold. So I would just say that, it's critical that you get the right people on your team to talk to and guide you along the way, but you're definitely going to run into some issues. So I would just say, do not give up. um, Keep pushing forward. And I think if you've got the right idea and the right partners, like, anything can happen.
Well, I think that anybody that's going through struggles in business, one, you're not in business if you're not going through struggles.
Yeah,
So
yeah.
let's get that one straight. And two, it's always a good time to connect with you to be able to have a discussion about where your business is, what are your options, what are the pitfalls that you're not potentially looking at. Because I know once upon a time when I thought I was inevitable or I was invincible. That's what I'm looking for. I
Yeah,
didn't see the word inevitable. I saw invincible and
yeah.
didn't take care of a lot of things that should have been taken care of. And things would have been a lot easier along the way had I taken care of the
Hmm.
valleys while I was in the peaks.
Yeah.
So I know our listeners are going to want more from you. How did they start that journey with you?
I would say check us out on our website, www.revxwealth.com. So revxwealth.com. You can go on there, send us an email, talk. Again, we have, um, coming from the restaurant business, I was used to working 24/7. So I answer my phone 24/7. I answer emails, to the chagrin of my wife, and everybody around me is always yelling at me because I'm always on my phone. But, like, no time is a bad time to contact us for the simplest of questions. Like, we're not going to charge you a fee to answer a question, or there's no strings attached. But I can promise you, if you reached out to us and had a question, we could create value. And if we can't answer the question for some reason, we can point you in the right direction.
Love it. So we will, of course, have all of Frank's links in the show notes. So go ahead and scroll down, click on the links, and open up in a new browser because, of course, we're not done yet. So, Frank, I get to ask you, at what point in life did you know that you were special kind of crazy enough to think that you could become an entrepreneur?
I knew early on that I could be an entrepreneur, but again, sometimes you go down that road and you realize, hey, you need to pivot. And I realized at age probably 28 that I did not want to be in the restaurant business anymore. And I, it honestly took me several years to get out because my father had done that, and he had kind of groomed us to take over the business. And I had to tell him I didn't love it, and it was destroying my personal life. And so I walked away from that and got into, this, financial planning / real estate business. And it was challenging. I used to say I felt good on a Friday afternoon, and by Monday morning I was scared to death that we didn't have enough going on there. So I would say, find something you're passionate about. If you don't love what you're doing, you don't love your business, like, you're probably gonna fail. But if you do love your business, you love what you're doing, you love the people you're working with, like, just do not give up. Keep pushing forward. But I would say I always knew I wanted to be an entrepreneur. I didn't want to work for somebody else. And there was days where, I had next to no money. I was doing cash advances on 10 different credit cards just to pay my bills. And I look back on that and can kind of say, you know what, today's not that bad. I've been through a lot. And I think it's important to like self-reflect. I get up every morning and do like positive affirmation stuff. And then like as I'm winding down my day, driving home, like I might have to search, but I'm going to find one or two things that were positive about the day and say, okay, I'm going to focus on that instead of the 10 negatives. And I think it keeps you mentally positive with all the stuff you're navigating.
I love it. You've been absolutely fantastic. Thank you for your time. I appreciate it immensely.
Yeah,
I know how
thank you.
valuable it is.
Thank you. Appreciate it. Nice speaking with you.
Peeps, this is Michelle Nedelec. Thank you for being here with us today. Be sure to subscribe to the show, share it with your friends. We love helping entrepreneurs grow.
Are you running a business over 7 figures but still struggling with technology headaches? Pay attention, you do not want to miss this offer. This podcast episode is brought to you by Awareness Strategies, who is offering a custom-built digital adoption roadmap for anyone running a business over 7 figures who's wanting to grow their business in the next 5 years. And it's not just a roadmap, they offer full implementation as well if that scares the out of you. Check out awarenessstrategies.com/roadmap for more details today. The link's in the show's notes. Don't regret not doing this. Do it now. That's awarenessstrategies.com/roadmap.